one we did was went on for an hour and got a ton of people and a lot of feedback. Today we're gonna be covering sort of a unique topic, and it's a thesis that we have at Centora that we have been working on, and it's quite controversial, related to how we think AI, bulk curation in DeFi is gonna move towards AI, and how is that gonna happen. But before that, we always like to start this webinars with an update on Centaura. The last 3 weeks, I think the update on Centaura is that we survive everything. I don't know, like I feel like anything else that we have done, it just pales in light of the events that have taken place in DeFi. So I want Anthony to give an update on the weekend events and maybe some of the other exploits. What's our view of what's happening in DeFi and what happens going forward, and then we can go to the core topic. So Anthony, how do we do over the weekend? You're muted.
Yeah. Okay. So uh, I'm not going to get into the hack. Everybody's read it at nauseum. The exploit. Um, there's a 250-ish million that people are playing hot potato with to see who's gonna take that loss. Who is it? Users? Is it Aave? Is it Layer Zero? Is it Kelp DAO? Um, this lack of certainty led to a systemic bank run. Um, you know, Aave users who were concerned about taking a capital hit to bad debt um, either pulled their funds or borrowed more against their collateral if they couldn't pull their funds out. And what that essentially led to is the ETH markets and the stablecoin markets being frozen. ETH was frozen completely, and now it's unfrozen. But all of these markets are at 100% utilization. So essentially, people are trapped, and they have no incentive to leave until this gets somewhat. We get some more clarity on the situation. Um, this pulled people. So while your funds were frozen at Aave, this created large uh, LPs to exit the market in Euler, Camino, Fluid, Morpho. So at the start of Friday, Centaura had 2 billion in vaults that it curated. We have a little bit. I think we're back down to about 1.2 billion. That all happened by Sunday. So we lost about 800 million of TVL. This was a feature and not a bug. While other people were trapped on other protocols, users who deployed into our vaults were able to meet redemptions. Now, they weren't all
I
instantaneous.
think we were the only source of liquidity in the entire market for
Yeah,
almost.
yeah, yep. So people were able to meet liquidity. We were in, our vaults are essentially Bitcoin, ETH, Maple, and Athena. We were in touch with them all weekend. They've done a fantastic job meeting redemptions. They did a fantastic job moving their exposure away from Aave so they could meet redemptions. So I couldn't be more, we did very deep due diligence on both of them and feel very confident in our view on them, and they performed as good or better than expected in which is probably the most stressful crypto event I've been through in 5 years. And that includes FTX and others. Now, what I will say is, our vaults are still open for business. There's plenty of liquidity if people are nervous and want to leave, and totally respect that. But rates have increased to compensate for the higher risk. So, I think the biggest kind of hanging chat in the room is what is Aave going to do? Now, we've had a lot of debate about this, but I think the longer the situation on Aave persists, the risk of more and more bad debt accumulating increases. So this frozen market is actually giving us more risk. There's kind of three scenarios. One, which is actually happening right now, is that the dollar value of ETH at the time of exploit has increased about 10% because ETH is rallying. If ETH continues to rally, the dollar amount of socialized loss continues to increase. Second, if the market goes in the opposite direction and ETH sells off significantly, there is no ETH for the liquidators to take to sell because it's 100% utilized. This will just lead, and as the market goes down, if the market goes down material, it leads to larger and larger socialized losses while the market's frozen. The third outcome is something that we can debate how long it'll take, but the longer Aave stays frozen, the more redemptions Athena and Maple are going to see. Now, while they've done a fantastic job, neither of them can meet 100% redemptions tomorrow. So if the pace of redemptions continues, and this is happening because many people have looped these assets and they're severely negative carry. So as this time of the markets being frozen increases, the negative carry increases significantly, and the ability for these two players to meet redemptions decreases. So at a certain point, the negative carry will force liquidations on Aave of these assets. And if these two players are at the end of their redemption availability, the liquidators aren't going to want to buy these liquidations because they typically buy them and redeem them with the issuer. But if they can't redeem them with the issuer, where they'll be willing to bid them is much below where the set limits are. So this can just lead to tremendous amount of bad debt. So while people are deciding the fate of DeFi, the probability of loss is just growing day by day by day. And what could have been a $250 million issue could easily mushroom into hundreds of millions more. So stay vigilant. I would suggest that leverage is kept to a minimum. This is not about yield; this is about capital preservation. And deploy. So there's certain people that have to deploy capital on chain. That's part of their mandate. With Aave being uninvestable at this moment, Euler markets, Morpho markets, Camino markets are functioning, and most of them have been almost completely de-risked. But this is not investment advice. This is safety advice. Back to you, Jesus.
So we have had numerous debates about this. Can we talk about what do we think happens to DeFi? So this number of exploits, how can DeFi look different going into the next year or so?
I think before we get into that, it might make sense for you to talk about your Mythos paper and then how you.
You told me not to. You told me to stop talking about it. I'm a scary
we'll take a less scary tact and just use it more to set the framework.
No, so a couple of so the overarching thesis is that I think exploits are gonna get worse. And that is something that it seems like in DeFi we're trying not to pay attention to that message, to ignore it. So when we went to the 22-23 market crisis, the overarching idea with DeFi, certainly a thesis that we subscribed to, was that protocols were going to get more resilient as they built more and they saw more exploits. And that happened for a while. So you had the Morpho Oilers, the Aave V3 launched, but I think nobody anticipated that the sort of AI renaissance was going to happen, and these frontier models were going to accelerate a lot, and then they were going to develop cyber exploit capabilities. So a couple of weeks ago, Anthropic did all this PR on Mythos. So the new upcoming release, they just released Opus 4.7, but apparently Mythos is the next thing coming, that is show capabilities on this area of cybersecurity called zero-day exploit, in which was able to find a bunch of vulnerabilities in codes like OpenBSD that were 26 years old. So the way I wish AI executes is typically the frontier labs, Google, OpenAI, and Anthropic releasing models, and then the Chinese lab, DeepSeek, Kimi, CAI, they catch up in about 5 to 6 months. So I believe in so initially it might be a mythos thing, but in 5 to 6 months you're going to have five, six of these models that are open source that you can modify. Um, that are going to have enough capabilities. So imagine a world, so the attackers today are scanning every single contract, poking every single sequencer, every single node, every single validator, and it's very simple to do. And in crypto, we don't have the defense capabilities for that, which is quite paradoxical because we're protecting money. And by the way, this is a topic of our next webinar, so I don't want to derail. Just a spoiler alert. So the fact that we haven't built that resiliency and we haven't built the cybersecurity talent in-house, it makes the industry very exposed. So in a world in which people are, being paranoid about quantum and Q-Day and all that, we should be really paranoid about this. The reality, now that doesn't mean DeFi is going to collapse or anything like that. There are things to do. But what it does mean very clearly is that attacks are just going to be more frequent and a much larger scale. This was a pretty sophisticated exploit. What happened on there, like finding that isolated validator, finding the RPC, but injecting the code, bridging the thing. I mean, it's a multi-step hack, quite sophisticated. So it was clearly AI driven, at least the vulnerability discovery part of it. So with that, we think DeFi is fundamentally going to change. And there are a couple of paths that it could take. One is we need better cyber capability, that's for sure. But that's going to we don't know how that's going to play out. We need the protocols to invest more in this area, implement circuit breakers and all that. But there is also basic stuff that can be done, right? In terms of the bridges, in terms of the protocol withdrawal policies and things like that. And we believe that DeFi might not be an Ethereum thing. I think that's safe, right? In the future, it could be. I think there is a new generation of chains coming to market that have an opportunity to rewrite that playbook. Is that fair?
Yes. I think there's a lot of purpose-built enterprise blockchains that are coming to market very soon that have essentially they're going to bring new users to the space and rely less on the existing users within the space. I mean, hopefully at this point, people realize that the myth of retail DeFi is just that, a myth. With prior to these exploits, 85% of TVL on Aave was in less than 100 wallets. 94% of Morpho was less than 100 wallets. Like DeFi is purely institutional at this point of scale. But and what we've seen through our Crack and Earn program, we have about 140 million there now after a few months, with almost 30,000 users. So this is Kraken onboarding new users into DeFi. And I think chains that are bringing in their own users that are not existing DeFi members through abstraction are not going to need to rely on Ethereum or Solana or Base for liquidity. They're going to bring in both sides of the trade. And their ability to do that and their ability to ramp customers into the space would allow these chains to be built in more of a walled garden protected way with minimal reliance on bridges. And that's how we've been advocating to these teams is if you don't need liquidity from other chains and you make it restrictive to move capital in and out of your chain, then the risk surface shrinks materially, right? It's almost like saying I go into a bank vault to steal money, but the second I get inside the vault, all the doors locked up, right? That's the type of environment that we need to create going forward until the AI defense mechanisms get better than the attack mechanism. And I think that's going to bridge us through from the situation we are now to where we're going in the future. But it does raise a red flag of, is ETH DeFi going to recover from this with this new paradigm? And the answer is I don't really know.
Okay. So on that optimistic note, let's talk about the topic of today. So two exploits ago, which was 3 weeks ago, we had the resolve exploit that there was. We can go through the mechanics, but there was an event there that people kept deploying on the bots when while the exploit was ongoing, and that together with some thesis that we have been developing internally, it sort of made us draw a line on the sand and say, hey, we're gonna move all our AI curation to AI agents in the future. And I think we wrote a very extensive paper that is gonna get published. And we wanted to have it published by today, but I think by next week should be public, and also a vision paper that outline this idea that we think bulk curation is too complicated for humans, and this is how it should evolve towards AI agents, and why. So and that is sort of the probably the maximum expression of a journey that we have been on for the last uh 8, 10 months or so, since we started doing bulk curation, that in which we built a lot of automation from the beginning, a lot of AI capabilities from the beginning, but obviously rely on our human curation abilities, even though the entire infrastructure is automated. We think the future of AI bulk curation is going to get more complex and therefore better suited for AI agents. But how do you think about about the space? I think you use this nomenclature that I sort of like, that they're bulk curators and risk curators type of thing. And what is the difference, and why is it so complex to create a bulk?
I mean, obviously, Jesus has the AI expertise that many don't, and I definitely don't. But we can talk through all the the increases due to AI, but at the end of the day, almost um, all of these exploits have been due to poor asset selection and weak due diligence on these assets. Right? If you want to dummy it down for someone like myself, the reason we had no exposure to RSE and why we decreased completely our exposure to Aave was we didn't RSE never passed our due diligence, and then once that got added and caps got increased, we got extremely uncomfortable um, with that exposure. It's the same thing with usual stream finance, Renzo. um, I'm missing a resolve.
Resolve obviously is
Yeah.
example that were.
So it comes down, a risk curator is someone who does extremely deep due diligence on the assets, because putting a couple assets in a pool and setting an interest rate model and throwing some incentives on it isn't rocket science. So that makes you a vault curator. What makes you a risk curator is extensive due diligence, handcrafting the assets and crafting the liquidity profile and the LTVs. And it's a different bar. It's a different level of sophistication. Unfortunately, risk curators and vault curators are all clumped into the same bucket. So, we've been trying to differentiate ourselves as a risk curator, but I think still too many people compare us to other vault curators where we're quite different.
Yeah, and what makes a process of curating a bulk, like just at the pure, let's say, asset selection, bulk configuration, all that, like what are the complexities of that process?
Yeah, I mean, did we see the issue within uh, RSEs? The answer, and is that why it failed our DD? No, they failed our DD within the first 20 minutes of the conversation. There's a certain bar that we set on professionalism and risk management that comes through very early in conversations. I don't even know if we made it 10 minutes into that conversation. So we didn't have a detailed write up of why and the risk exposure this had. We just knew we didn't want to be exposed to it. I think understanding the project needs to explain all the attack vectors it has. We've never approved a project that has off chain risks that we can't see as visible. right? That's just not something we'll ever um, acquiesce on, and that is, stream finance was one of the ones that helped us avoid, because the off-chain doesn't work for us. Where projects that we do prove have off-chain components, we have full visibility on an almost near real-time basis to those off-chain components. That's a requirement that we have. And then it comes down to, if it passes those constructs, and this is getting a little bit more into yield-bearing assets and RWAs. Why does the high yield exist? What is the risk? What is the capital constraints within the market that a RWA can pay 12%, can pay 7%? And if there isn't a real answer for that, we immediately dismiss the asset. Now, there are reasons why an RWA, there is reasons why an RWA can have a high yield compared to what normal markets allow. And that's in a very specific situation. And these opportunities and pockets do exist. They exist mainly on the back of the Dodd-Frank regulation that came out post global financial crisis. What Dodd-Frank did, a lot of lending went through banks leading up to the global financial crisis. Dodd-Frank was a little bit of baby with the bathwater. Well, it tried to take shadow banking and risk off banks' balance sheets, which it did successfully. It also decreased the amount of appetite banks had to lend to the real economy, like SMEs. And that also moved over into the private credit world. So there are situations like Prime, which is a product that we're bringing to market in Ethereum that we've done a tremendous amount of research on. The reason they're able to pay such a high yield is banks are not in the HELOC market anymore. They don't have the capital or the appetite to underwrite the risk and lend the money against HELOCs to the extent that the demand in the market exists. So that allows other capital providers to step into space and provide capital at much higher yields. We're looking at a project now called Huma, which has been around for quite a long time. They have a similar problem. They lend to very short-term, bridging the gaps between payments companies, receivables, and payables. But again, this is not a market that banks tend to participate in, and the rates are astronomical compared to the risk. Right. So those are the real projects we're looking for. So it's about visibility, then it's about feasibility, which is can these RWAs actually attract capital at these levels, and can they lend it out at levels that are attractive?
Yeah.
And then once you pass those two, it's about liquidity, right? I mean, it goes back to the simplest thing we do. If you put an asset in a pool, can it be liquidated under stress? And this is a big reason where we've held back participating in tokenized private credit, because there's no private credit issuer currently that has enough secondary liquidity where we feel comfortable putting our depositors at risk against that collateral in our bonds.
Yeah, so the question is, why is this an AI problem? And it's a development thesis, but here's what we do. So when we started looking at Vault, we wanted to do the same thing that we do for DeFi strategies, that was automate everything. And then when you look at the way Centaura constructs Vault, it was once the due diligence passes, the Vault, the risk parameters are set. That modeling process in and of itself is very, very AI centric. Then we go into a process of automating the Vault construction, in which we deploy the Vault, we fork the chain, we do the testing, then we do a automated testing process in which we fork the chain again, simulate different scenarios. And then there is an entire monitoring process. And then every single week, we have to deal with scenarios of, oh, we need to change this, we need to change that. And one of the things that was obvious to us on the resolve issue was that a lot of these vaults were not optimally configured. So when you look at a protocol like Morpho, by far, Euler in a lesser scale, but still, they're extremely complicated. So they have hundreds of parameters that you can configure. And to think that a human is going to have a perfect configuration for a given market condition is insane all the time, right? Is insanity. And then that is that's one vector of the thesis. The second vector that I think is quite interesting is um, if we do believe that agents are proliferating, right? We're going to have billions of these things running around. And some of them are going to interact on chain, and some of them are going to transact with DeFi protocols. Do you really want agents participating in DeFi and dealing with human curators? That doesn't make any sense, right? Like if right now we cannot deal with human hackers, right? Imagine when you have a billion of these things interacting at a massive pace. Now that doesn't mean that we replace everything, but one effort that we started from that entire life cycle that we looked at, the number one problem, the most difficult problem is both optimization. Here's a market. I would like to have the optimal risk-adjusted return, or the optimal return, or the optimal risk, or the optimal something else, an objective function, and then give me the optimal configuration for that. That is monumentally hard to do by a human curator, but it's a classic optimization problem in AI. So one of the things that we do that hopefully we'll be able to show publicly, very very good, um, is we have one of the best research teams in the market, if not the best. Like this our research team is as hardcore DeFi as it get, and we have built our own bot optimization methodologies and statistical analysis and things like that. And then we had an agent. We built an agent that essentially looked at one of our bots or in a gauntlet or a stakehouse bot and say, I want to optimize this. And then it bid our internal optimization by like amount. It shows like our own bots could be making $1.6 million more a year by changing the order of transactions for a given market. And that is insane. And we're very good at this stuff, right? And we still, we run this thing for half an hour and say, hey, by the way, you missed all these other things, right? And if it's about making more money, that is um, one aspect. But then when you're missing something on risk, when you don't have the optimal risk configuration, that's probably more complicated. That is what results shows, right? Like a lot of the parameters on the ball, the creation were not set up. Like the capital was still flowing into the some balls when the hack had already happened, right? So that's what we think. This is a world in which AI agents should do, the vast majority of the curation. How do Anthony? What do you think?
No, I think that sums it up. I think there's kind of identifying opportunities to create vaults. Then there's creating the optimal construct of those vaults and having that all automated, both using AI and the way we actually launch the vaults. Because if anyone here has actually tried to launch a vault manually, it takes hours and hours and hours, especially if it's your first time through it. And then you have to test all the parameters if you're doing it properly. It's a very painful task. And then, so that's kind of like table stakes. And then it goes into, you want an agent that's constantly optimizing so that the pool can be the most efficient and you get, the right liquidity to the right assets. Now, Morpho offers a reallocation bot, which is both good and bad. And it's good where it keeps the liquidity efficient and the rates efficient, but where it breaks down is if an asset gets exploited and the curator doesn't recognize that an asset got exploited, it will continue to feed idle capital into an exploited asset pool.
Exactly.
And that's what we saw happen to another curator on Resolve and others. So
and the bot is not able to react to that, which is what you want. You want the bot to be intelligent and say, I need to shut this down.
Yeah. So we don't use allocation bots very often. And when we do, we use it for a short period of time and shut them down. We are building as part of our risk suite, and maybe I'm committing to something that Jesus is going to kill me for, but Um, we are building an alert system where if an asset that's included as collateral in our pools mints above a certain size in a certain period, it auto freezes any allocations in our vaults to allocate. At that point, we would turn on the reallocation bots. But until then, we just find it too risky for too little return to allow bots to just reallocate blindly when it doesn't have a risk view. And then I think the last piece is what Jesus and I argue about, but basically creating our own North Korean bot to challenge all of our risk assumptions and exploit assumptions. I don't think we've made a ton of progress there, but I would really love that in-house attacker that would basically keep us at the forefront of risk management.
So I think we're going to a future in which, I mean, I think DeFi in general is too complex for humans, and it's probably gonna be a home for agents, and I think bot curation is probably a maximum expression of that. Like a lot of the on-chain lending or AMMs activity and all that is probably gonna be AI driven. So we today you have Centaur Steakhouse Gauntlet type of top curators. I think in the future is either gonna be us with agents or it's gonna be other agents uh, doing that. But this ability to, hey, I want a bolt and construct it on the fly, and I want to optimize it all the time and be able to say I have the most optimal configuration for these market conditions. This is a classic optimization problem. So to talk a little bit 5 minutes about how we're doing it. There are two approaches. So I mentioned we had all this statistical work that we have done that we thought it was super clever about this is the optimal capital allocation, the order of transaction, the different distribution of parameters for a given vault. And then we built an agent that just went around and look at all the parameters and say, hey, this is what I want to optimize. And I start running Monte Carlo simulations on a given loop and say, hey, I'm going to run this scenario. If it fails, I kill it. If it shows that it can work, I'm going to keep going with it and do another refinement, do another refinement. And that shows like that's the one that shows, hey, by the way, if you reorder the transactions this way, it's just like 100 transactions, so it's not a very obvious thing to see. If you reorder this way, you can make this much more a year, and we're like, okay, that sucks, right? Like the thing ran for half an hour and told us that everything we did for the last month was still not optimal. And then now we are trying to see. So that was an agent with a traditional Monte Carlo engine, like traditional simulation engine embedded in it. And now we're trying to see if we push the boundaries of this. There is a framework that was launched about 2 months ago called Auto Research, that it was created by this famous AI sort of evangelist called Andrej Karpathy. Andrej Karpathy was a very early OpenAI engineer that went to Tesla and was responsible for building the autopilot sort of in the way we know it today. And then we went to OpenAI, and then he's now working on some education company called Eureka Labs. But he's a very well-known AI researcher. Like he open sources a lot of stuff. And a while ago, he published this framework that essentially has an AI agentic loop for optimizing AI models. So you take a machine learning model and you say, hey, you to optimize the configuration of the what is called hyperparameters of this model. And the thing shows a monumental amount of progress. So we use it internally for other agents that we're using for discovering strategies and risk and things like that. And it's pretty incredible. And now we're using it. We're trying to adapt the ideas of the framework for this. Essentially is very similar. It takes a bot with a bunch of parameters, and it tells an LLM, look, here's my thesis. Can you go and give me an idea how to optimize? And this thing will say, how about we change this? And we simulate that. It changes that and say, oh, that didn't work. Try again. So it's a dumb loop like that, but when you run it continuously, it shows incredible results. So in that sense, what our North Star is going to be is in our first release of our Bolt agents, we want to see that at any given point for any market conditions, we can tell our clients you have the optimal Bolt configuration. So if we're doing that, we know we're both safe, but we're also optimizing for the performance of the Bolt. And that's going to be something that we're probably going to announce in the next few weeks. So I think that's probably the core of what we wanted to cover. I think there are a few questions. If we can use the last few minutes, so the 45 minutes for questions. So Shreya's asked, it's about the first topic. Do you think it's possible to train machine learning models to find and execute attacks in a sandbox for a smart contract? Yeah, absolutely. You don't even need to train anything. So you can, of course, if you fine tune something, it's better, but you can just take code, give it a smart contract of a DeFi protocol, an endpoint, and say like, find me vulnerabilities on this and be able to and generate the code yourself and all that and do that in a loop, and you will be shocked at the number of times I find things today. I mean, don't do it with Aave and all that because it's smart robot, but do it with pick a tier two protocol on any chain and you will see. You will be, and that's a zero shot, no training, no nothing. So that this is very, very simple to do. Today, now multiply that by a ton of models, a ton of North Koreans, a ton of attackers and all that, and that's what we're dealing with these days. Um, then I think we answered this. Bolson asked risk management report published by Centora based on the project that we have evaluated before. Yes, so you can find it in Centaur Research, but we're launching a thing called a Smart Geo Public that is a public version of our platform. It was going to be this week. We postponed it based on the market events. We want to give the market a little bit of time to settle. So in the next week or so, this is going to be public, and that's going to have all the key reports, the ones that are hard to assess, right? Like Maple, Prime, like those type of things. You're not going to see STs, but a lot of the assets that our team has spent a lot of time looking at it. Hamza asks, what are the risk factors you consider for allocation? So it's many, right? Like typically you have the health factors, the distribution of the assets. So there are many things that go into depending on how do you configure a given bot. Yeah, Anthony.
I would say here's a good example. We have not really been involved in the ETH, the LST LRT looping trades with ETH, which has also led to a reason why we didn't have any exposure on Aave. We felt that people were looking at the risk of this trade incorrectly, and there's two TradFi risks that we apply to any looping trade. They're called duration and convexity. So duration simply means how long does it take to unwind a loop position. So this is very relevant for LRTs and LSTs because the size of these trades is much bigger than the secondary liquidity. So if you have a 100, 200, $300 million WE looping trade, the exit queue is extremely important because if the exit queue is 10 days and you have 10 loops, that's 100 days to get out. That's a very linear, the equation is slightly different than that, but it tells you, okay, so if you can stake at 3%, restake at 3%, and you have to do 10 loops to get to 6%, is that 100-day duration the right risk reward? We believe clearly not. Obviously, the rest of the market clearly did. Then there's this other thing that we add is what's called convexity. So the way and really it's negative convexity. So in a situation like an Athena and a Maple have a very static, 1-day redemption period, and that could get challenged at times of liquidity, but it's generally static. So if you have 10 loops and it's 1 day, the duration is pretty small. So we're much more comfortable looping outs like that. But with LSTs and LRTs, that redemption window isn't static. And with DATs spinning up a lot of their own validators, the entry queue got extremely, extremely long starting a few months ago. What that did is it pushed the rates of staking and restaking down significantly, while the rates to borrow ETH were somewhat stagnant. But this situation now is going to prompt a lot of people to want to hit the execute. So the execute 2 or 3 weeks ago was almost zero. Now it's approaching 10 days. And as this unwind grows, that exit window can expand. So if you take duration and then you add convexity to it, which is the volatility of duration, you essentially get to a thing say, so it's 100 days now, but in a stress event, if the execute goes from 10 days to 30 days, well, then your duration goes to 300 days, right? So you can't just look at a fixed moment in time when the execute can move. So all of those risk factors combined, we just said the incremental 2 or 3% is absolutely not worth these type of risks. Hopefully that makes some sense.
Yeah, there is another question. So CD said, what do you specifically expect to trust an agent curated vault post USR reallocation situation? I feel that a swarm of agents that can actually identify on chain exploit in due time to post reallocation is super far in the future. So this mixing two topics, but I actually don't think he's gonna like the answer. I actually expect everyone to over time to trust more AI curated bots than human curated bots. And by the way, when we say AI, it's AI with human supervision. It's not autonomous. But if you think about it, the ability to have the optimal configuration of the bot for a given market is a huge safety vectors, right, to prevent attacks. And then the second one, that is the one that is alluding to the ability to react to an uncertain market event and saying, hey, I'm going to pause and see that's something that an AI agent is always going to be more efficient than humans. Doing this year, there's going to be a ton of false positive, and that's probably fine. And in terms of the argument of cost of compute, not really. Like inferences costs are going down in every release. Like there is all this report of a lot of the inference today is being run in previous generation GPUs, like H100s, not even H200s or things like that. So inference is becoming extremely cheap. So I don't think the cost in tokens of something like this is anything prohibited. And then there is one for Anthony here. I'm going to start this saying we don't criticize by policy, we don't criticize any competitors, but the question is what is currently lacking among risk providers in DeFi, OPSEC across the DeFi stack, or just market economic or qualitative?
I would say maybe what I can say, I don't have a view, like I don't know the internal workings of our competitors that well, but so I can speak about how we do it. We have multiple disciplines within our shop. So we have a 65-year-old PhD risk manager who's been around since the savings and loan crisis, who teaches at NYU, who writes textbooks that used to be on my trading desk 20 years ago, who's a very formulaic approach to risk. He's been a risk manager for a long team. We have traders who used to trade short-term interest rates, which is very much like the market in DeFi. We have smart contract engineers are best in class. We have researchers. We have liquidity managers. So I think too many curators look at risk curation as a technology risk management, and we look at it as economic liquidity and technology. So I think that, listen, this isn't a perfect science and we're not infallible. On a long enough time horizon, no one's going to be perfect. So we strive to be perfect. We strive to be vigilant. But, even as we've seen in multiple financial crises, no one's perfect on Wall Street either, even if they have CFAs and CPAs and MBAs, doesn't really matter. It's always about just being vigilant. And I think as the market evolves into RWAs, there's an even deeper understanding of credit risk. So we're in the process of hiring a traditional credit risk officer to add to our team as we get into private credit, public credit, more lending businesses, because we feel that is absolutely necessary before taking on those projects. So I think we're good at it, understanding what we know, and really good at understanding what we don't know. And in those areas, we look for reinforcements.
Cool. So the next webinar, I don't think we have anything pending. On the queue then, oh yeah, we do. How do we move from manual to systematic due diligence for those assets? AI. So we use a lot of AI. The amount of AI that we use in due diligence for things is insane. So if I'm not saying this in a braggadocious way, like I think our risk team knows more about some of those assets and protocols than the actual creators of those protocols. And we're constantly pointing to stuff like we go that deep, and obviously a lot of that is AI helping us. With that, and from there on out, it's all automation. So the next webinar is going to be on the AI cybersecurity state of affairs in DeFi and crypto. So if you like the intro to this webinar, register for that. I think the link is in the webinar. It's gonna be a super intense discussion. We'll see who joins from our team, but let's join that one. It should be fun. One last question to close. Anthony, how do you view the bills as oh my God. How do you view treasury bills as RWA in the current DeFi state?
I think there's a use case. If you have the ability to buy T-bills, it's cheaper to buy them in your Morgan Stanley account or your Fidelity account than it is to buy it on chain. Full stop. If you don't live in the real world and you have capital on chain and have to allocate on chain, I think it's a valuable asset, and I think Securitize and BlackRock leading with BUIDL is fantastic. USYC is fantastic, and it's very purpose driven. I think there was a little bit too many people in this last cycle who are looking to enhance yields through leverage looping, but the challenge is that the liquidity is still on a T plus something basis in the real world, as opposed to instantaneous. And the only reason some of these trades were loopable was because we were at the most depressed levels in DeFi borrowing yields almost ever. So after these exploits, the borrow rates are just going to be higher than T-bills. So I think if you need to own them and they're a safe place to keep your money, if you're an on-chain operator, they're great. I just think these leverage use cases aren't going to make sense anymore.
Cool.
Great.
All right. With that, I would like to thank you guys very much for joining and staying with us. And we'll see you in the next one.
Thanks, guys. Appreciate it.